12 ads. That's how a bubble announces itself. In January 2000, 12 of the 61 Super Bowl commercials were bought by .com companies at up to $2.2 million for 30 seconds. Most of them were gone within 2 years. But the internet was still real, and that's the puzzle we're here for. There's one test historians actually use to tell a bubble from a boom, and neither side of today's argument can dodge it. I'm holding it back until you've earned it. Park that.
Erica here, 12 ads, and here's what people forget about them. Every single one was selling something that worked. The web was real. Shopping online was real. The technology delivered exactly what it promised, but the companies died anyway.
Last time out, we followed the money inside one chatbot, why the machines lose billions of dollars a query at a time. So today we pull the camera back and ask what follows from it. If the losses are that big, is the whole thing a bubble?
78%. The Nasdaq lost that much from its peak by October 2002. 6 years of gains, gone. And the internet won anyway.
Walk with me on the question itself, because most of the internet is asking a broken one. Will AI work? It already works. You used it this week. Answering that tells you nothing about whether anyone overpaid for it.
Here's the question that actually pays. Not will it work, but has the price run past the cash it produces? Those are two different questions, and almost every headline welds them together, which is why nobody can.
If the AI bubble pops, does that mean the AI stuff stops working?
No, not quite the way people mean it anyways. The reason sits in a word we've used 4 times without defining it: cash. A bubble has a technical definition, and it says nothing about whether the machine does its job.
(1637) Dutch tulip bulbs. At the top of that market, a single rare bulb traded for more than a craftsman earned in a decade. The bulb still did what bulbs do. It grew a flower. The flower was never the problem, and they painted the traders as monkeys precisely because everyone knew it.
Take the word apart, because everybody throws it around and almost nobody defines it. A bubble isn't a synonym for a mistake, and it isn't an insult aimed at the thing being traded.
The price runs past the cash. Here's the definition, and it is the whole definition. Every asset is ultimately a claim on cash it will produce: rent, earnings, fares, subscriptions. But when the price people pay stops tracking that cash and starts tracking what the next buyer might pay, you've got a bubble. Notice what's missing from that sentence. Nothing about the technology. Nothing about whether the invention is any good. A bubble is a statement about a price, and only about a price.
2 ledgers kept apart. That is the safest route through this argument. I mean, safest if you actually hold the line, because the second you let them touch, you're arguing about faith instead of numbers.
1929, same shape. The factories were real.
Take the fair objection head on, because it's the one that stops most people cold. If AI is so useful, how can it be a bubble?
Because usefulness puts a floor under the technology, not under the price. The .com years proved you can be completely right about the invention and completely wrong about what it's worth on a Tuesday in March.
Sure, but does the usefulness protect the price or not?
Not for a second. Do the arithmetic with me. 5,048 at the peak. Knock off 78%, call it 1,100, and the index did land near 1,100, while every one of those companies still had a working website the next morning. The usefulness held, the price didn't.
2 columns. On the left, what a bubble is: a price past the cash flow, buyers buying to resell, and debt paying for the build.
Right column now, what it isn't. Technology that fails, a useless invention, a verdict on the thing itself. None of that is in the definition.
Which means something almost hopeful, and nobody says it out loud. When a bubble pops, the money burns, but the stuff stays. The rails, the cables, the buildings. I've started calling that the leftovers, because that's what it is, what the money leaves behind after the money's gone.
Okay, the test we owe you is a cash test, not a technology test. What money does this thing actually produce, and when?
2 ledgers, one for the machine, one for the money.
Never the same ledger.
Before we keep going, one small favor that actually moves the needle. If this is landing for you, tap like, then subscribe and turn on the bell so you do not miss the rest. 2 taps, completely free, and it pushes this in front of more people who need it.
Run the tape, 2000, beat for beat.
March 10th, 2000. The Nasdaq closes at 5,048.62, 600% above where it sat 5 years earlier.
Then October 2002, down 78%. Amazon alone lost more than 90.
Somebody who knows manias cold should take this one. Professor Marchetti is on the line.
People say the dot-com crash as if it's one event. It was 2. The technology arrived, and it kept arriving. The financing arrived far too early, and it left. Those are different stories that happen to share a calendar.
So what actually killed the companies? The technology or the money?
The money and the clock. Pets.com is the honest example. 9 months from its public offering to shutting the doors, in November 2000, the website worked fine, the delivery economics didn't, and there was no cash left to wait.
A year or 2 to come back, right?
10 years, not 2, 10.
She's right, and it is the number that should stay with you. Amazon survived, won, became one of the largest companies on Earth, and someone who bought at the very top was still underwater around 2009. Being right about the company didn't save them. The entry price did the damage.
Ouch. Right about the future, wrong about the year.
The way people tell that story, forget the story. Start with what the money bought. What did the boom actually build?
Glass, millions of miles of optical fiber, buried across the country, financed by companies that mostly didn't survive to switch it on.
Is that where your read stops?
The equipment side I know cold. Once you get into the securities litigation, that's a different animal, and I'd want someone who lives in that world to take it. Thanks for having me on. If you keep one thing, keep this. The glass outlived the money, so that's the short version.
Professor, thank you. Genuinely useful.
Put the sequence on the board. 1995, the web goes mainstream. March 2000, the peak. November, Pets is gone. 2002, the bottom. And then, years later, the fiber lights up.
Glass. He said glass, and he wasn't being poetic. There's a physical object at the end of this story, and it's still in the ground.
"263 Acts of Parliament. In a single year, 1846, Britain licensed 263 new railway companies for routes adding up to about 9,500 miles.
Take the shape of that because it's our shape. Ordinary people put their savings into railway shares the way people talk about chips today. Clergymen, widows, shopkeepers.
About a third of those authorized lines were never built. Firms collapsed, investors were ruined, the debts outlived the companies. And yet Britain ended up with a railway network that's still moving people this morning.
55. Hold that number. 1873, America. A bank fails because it can't sell the bonds for a new railroad. The exchange in New York shuts for 10 days. By November, 55 railroads are gone, another 60 inside a year. But the people who ended up rich off those rails, it's not the ones who built them. Hold that too. It decides who's exposed this time.
Yet the tracks stayed in the ground. Every mile of it, bought cheap out of bankruptcy by whoever came next. There's a person I keep thinking about. Call her Ruth, 60-something, a school teacher, put $10,000 into Amazon at the top because her nephew told her the internet was the future. December of 99.
Spring, I thought. 99, but the spring.
Could be, doesn't matter, because the nephew was completely right. Amazon became one of the biggest companies on the planet, and Ruth's $10,000 still lost more than 90% of its value and didn't claw back to even for years.
So the lesson isn't that Ruth was foolish. The lesson is that being right about the technology and being right about the price are two separate bets, and she only made one of them.
Same decade, the cables. Global Crossing laid fiber under oceans on borrowed money. January 2002, it filed for bankruptcy, $12.4 billion of liabilities, because the demand for all that bandwidth simply never showed up on schedule.
Hold on. Dark fiber literally means what?
Glass in the ground with no light in it. They laid far more fiber than anyone could use, so most of it just sat there unlit for years. Dark.
Did it ever actually get used?
Used by whom, though? The companies that laid it, or the ones that came after? Two completely different answers.
The ones that came after. Those are the ones I care about.
Then the answer's yes, and it's the most important yes in this episode. The glass got lit. Cheap bandwidth is what made streaming video possible, so the thing you watched last night rides on capacity somebody else went bankrupt building. The investors paid, you benefited.
Builders lose, users win. Twice now.
94% down, 10 years to break even, and that was the good outcome. Erica, you've got both sets of numbers in front of you, and the exact number is where this argument lives or dies. Here's what's at stake for the person watching. Get this wrong one way and you dismiss a real technology. Get it wrong the other way and you believe a price nobody can defend. Erica thinks the spending has run away from the cash. Leo thinks the demand is real and arriving. Make the case.
Roughly $700 billion. The four largest American technology companies plan to spend that on capital projects in 2026, against about $400 billion in 2025. It's the biggest build-out of computing capacity anyone has ever attempted, and part of it is financed with debt.
Big number. Big isn't wrong.
No, but it has to be fed. In 2024, Sequoia published a piece asking where roughly $600 billion of annual revenue would come from to justify the build. That gap hasn't closed. And an MIT study last year found around 95% of company AI pilots produced no measurable return, a figure that is contested, and I'll say so plainly, but it's on the table.
Not quite an answer yet, Leo. That 600 billion gap is her strongest card. Go at it directly, not around it.
Take the gap seriously, then read the same author's next line. Sequoia says the technology is real. Their warning is about capital burned in a frenzy, not a machine that doesn't work. I'd put real money on that distinction mattering. Cost. Look where this is going on cost. Stanford measured it. Running a model at the old GPT 3.5 level fell from about $20 per million tokens to about 7 cents in 2 years. 280 times cheaper. So the unit economics aren't standing still. It's the whole argument, one number.
Erica, take that head on. He says the cost collapse eats the gap. Does it?
Partly, but here's where I won't budge. In October 2025, the Bank of England's Financial Policy Committee said valuations look stretched, particularly for AI-focused firms, and that the risk of a sharp correction has gone up. It also noted the top 5 companies are close to 30% of the whole S&P 500, the most concentrated in 50 years. When 5 names carry a third of the index, everybody owns this argument whether they signed up for it or not.
Central banks warn about everything. That's
It's their job, yes. It's also a published document with a number attached. That concentration figure isn't an opinion.
fair. That one lands. I'll take it.
Leo, your whole case rests on the hardware finding a new job even if the first owner fails. Sit on that, because your whole case rests on it. You're claiming the hardware finds a new job even if the first owner fails.
The chips don't evaporate. Somebody buys them cheap and runs better models on them. Same as the glass.
Let me put the thing neither of you has touched on the table. Fiber sat in the dirt for a decade and worked perfectly when they finally lit it. Does a processor age like glass?
No, it doesn't. Glass is patient. Silicon isn't. A chip's useful life runs in years, not decades. That's a genuine asymmetry, and I hadn't priced it. Hang on, why do we even call it a bubble? Who picked that word?
1720s London. A share scheme collapsed, and the pamphlet started calling the whole business bubbles. Thin, pretty, empty, gone. The word's 300 years old, and it has always meant the same thing.
Okay, we're 2 exits past the topic and I love it. But come back to the live number, 30% of the index, 5 companies. Now the test I promised you at the top. Historians don't predict. They watch 3 things, and both of these cases can be checked against them tonight. 1. Is the revenue growing toward the spending or away from it? 2. Is the new capacity actually being used or is it sitting dark? 3. Is the build paid for out of cash or out of debt? That's the whole toolkit.
$700 billion.
Run me through mine then. Revenue's growing fast, genuinely fast. Utilization is high, the chips are busy. Financing is where I go quiet. Family churrasco every month I can make it, and my rule at that table is the same as it is here. You don't order what you can't pay for when the bill lands. Debt is the part of my own case I trust least.
Yeah, both things are true. His revenue and utilization numbers are real. My concentration and debt numbers are real, which is exactly why this argument won't collapse into a headline.
Pause right here and write those 3 down. Revenue, utilization, financing. I'll wait. And let me be blunt about what this show isn't doing. Nobody on this panel is telling you to buy anything, sell anything, or move a dollar. We don't do that. We're not qualified to do that. And anyone who's certain about next year is selling you something. The sourced verdict then, and I'll name the source. The Bank of England's Financial Policy Committee, in its October 2025 record, valuations are stretched and a sharp correction is possible. That's a documented risk. It isn't a forecast, and we won't turn it into one. Where the room lands is this. The machines are working, the money is early, and those 2 sentences don't fight each other. The test just graded the people doing the building. But if it does correct, who actually eats it?
If it corrects, the late buyers. And the builders who borrowed. Not the people who used the thing, that's the answer, and history is boringly consistent about it.
55 railroads, the number I asked you to hold. The men who financed those lines were wiped out, and the fortunes showed up later, with the operators who bought the track cheap and the towns that could suddenly ship a crop. Late money loses, the user wins.
To borrow Bella's word from earlier, the leftovers. Everybody eventually eats off them, and nobody who paid for the kitchen is at the table.
Put the bill up, because it's the only figure that settles this. 2 years of building. About $400 billion last year. The exact number is still moving, but roughly $700 billion is planned for this one. More than $1 trillion of capacity in 2 years, and revenue has to grow into it. So watch revenue first. No, back up. I had that backwards. Revenue's the number everybody quotes. In the fiber crash, the tell showed up in utilization first. The capacity was there, and it was sitting dark. Watch what's being used.
Okay, the toolkit is 3 lines, not a prophecy. Revenue against spending, capacity used against capacity built, and how it's paid for, because cash absorbs a slowdown and debt doesn't. Run those 3 every quarter and you'll read this story faster than the headline writers, because they're grading the technology and the numbers are grading the price.
The way the capex works out to, forget the spreadsheet. Run it through a phone plan, because everyone here has one and it makes the mechanism obvious. The towers are the data centers. Your monthly plan is the subscription, and the carrier's loan on those towers is the debt. The company builds for the traffic it expects, not the traffic it has. That's the whole business.
Okay, but what happens to the towers when the carrier goes under? Do they come down? Because that's where the picture stops fitting. Nobody repossesses the coverage. The towers just get a new owner and cheaper prices, while the person holding the shares gets nothing at all.
Which is the rule, plainly. The capacity survives the owner. The price doesn't survive the glut. 2 different fates, and only one of them lands on you.
One rule you can actually use tonight, it isn't a stock rule at all, it's
Emma's laminated chore chart. Capacity outlives the landlord.
The chart is load-bearing and you know it. Also, you still owe me for the milk, so I'd tread carefully around ledger jokes.
Can we drop the will it pop question for a second and ask what each ending actually looks like from a kitchen table? I plan whole holidays around street food stalls, so trust me. I notice when the good stuff stays after the crowd goes home. That's the only version of this a normal person can use.
Here are both, honestly, and I'm not weighting them. Ending 1, the internet again. Revenue keeps climbing, the capacity fills up, the spending looks visionary in hindsight, and the price was early rather than wrong. Ending 2, the overbuild corrects. Some builders fail. Some investors are ruined, and the news is ugly for a year or two. But the data centers get bought cheap, the models get better, and the tools on your phone keep working and get cheaper, because the machines were never the problem. In both endings, the technology is still standing at the end. That settles it for me. The risk is real, the panic isn't.
Yeah, and where this is going matters more than when.
The honest verdict, and it's the last thing I'll say about anybody's money. If you use these tools, both endings are fine for you, one of them is just cheaper. If you own a piece of this, that's a decision for you and a professional, not for 4 people on a stage. And be kind to yourself if the noise gets loud, because nobody watching a mania from inside it has ever known the year.
Carry one line out of here. Real technology, possibly wrong prices, both true at the same time. Hold those together and you'll read next year's news better than the people writing it.
They buried the glass, went bankrupt, and we all stream on it anyway. That's the episode. A bubble is a price running past the cash, not a machine that fails. And the 2 facts to carry out of here are the 78% the Nasdaq fell while the internet won, and the 3 signals: revenue, utilization, financing.
Money burns, stuff stays. And your payoff is small and real. Next time a headline tells you AI is a bubble, you'll know it's making a claim about a price, not about your chatbot, and you'll know the 3 numbers that would settle it.
Next time we take the machine off the cloud entirely. Your own computer, your own model, nobody's rent, and the trade-off nobody mentions until you've already downloaded it.
If this gave you a straighter way to argue about it at dinner, hit like and subscribe. That's genuinely what lets us keep making the long, careful ones instead of the loud ones. Let me leave you the one only you can answer, and I'd love to read it below. When the dot-com money burned, the glass stayed. What's the leftover this time? The thing we'll all still be using in 20 years, long after the argument is over.
This one is worth a second watch when it applies to you.
Whatever it turns out to be, somebody is paying for it right now. Take care of yourselves, and we'll see you next time. Small definitions, well placed, save large explanations later.
Emma, that was the kind of teaching I usually charge for. 9 out of 10. This is Professor Erica. Thanks for watching and signing off.